Hey everyone, welcome back to Corporate Decoder. Today UHT just filed their second quarter 2026 10Q report, and I am seeing some interesting moves in their balance sheet. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is showing a nice jump in net income, but a closer look reveals a story of strategic asset sales and some important financing changes. Alright, let's dive into Universal Health Realty Income Trust, or UHT as they are known. They are a real estate investment trust mostly focused on healthcare and human service facilities. Think hospitals, medical office buildings, that kind of thing. Looking at their income statement, we can see that for the 3 months ending the 30th of June 2026, their net income came in at $5.9 million. This is a solid increase from the $4.5 million they reported in the same period last year. For the first 6 months of the year, net income also jumped from $9.3 million to $10.9 million. A big reason for this jump in profit, especially in the second quarter, was a gain on the sale of land. They sold some land in Chicago for about $724,000. While that is a nice one-time boost, it's important to remember this is not a recurring income source. Their main income comes from rent, and it is pretty evenly split between their big tenant UHS and other tenants. For the second quarter, they brought in about $8.3 million from UHS Facilities and $14.5 million from other leases. This was pretty much the same as last year. On the expense side, depreciation and amortization, which is basically the accounting way of showing that buildings get older and less valuable over time, cost them about $7 million in the second quarter. This is pretty stable year over year. Now let's scroll down to the balance sheet. This is where we see some bigger shifts. Their real estate investments, which include buildings and stuff they are currently building, went up a bit to about $682 million from $666 million at the end of last year. This shows they are still investing in their properties and adding new ones. One of the most significant changes is in their debt. Their borrowings on their line of credit jumped to $365.6 million from $356.2 million at the end of 2025. This means they are using more of their available credit. And this increased borrowing is tied to an amendment they made to their credit agreement back in April of 2026. They increased their total borrowing capacity from $425 million to $475 million. So they have more room to borrow and they are starting to use it. Overall, their total assets grew slightly to $567.1 million from $564.9 million. And their total liabilities also went up, mainly due to that increased line of credit to $423.2 million from $412.5 million. On the equity side, their capital in excess of par value, which is basically the extra money shareholders pay for stock beyond its face value, is holding steady around $272.5 million. Their cumulative net income and other equity accounts are also looking pretty stable. But what stands out here is their cumulative dividends, which are the total dividends they have paid out over time. This number is a massive negative $1 billion. This tells us they have been very generous with paying out dividends to shareholders, which is typical for REITs, but it's a huge number. This leaves their total equity at around $143.9 million, a bit lower than the $152.4 million at the end of last year. That decrease in equity is largely due to paying out those substantial dividends. Let's look at the cash flow statement to see how the money is actually moving. For the first 6 months of 2026, they generated $24.4 million from their regular operations. This is a slight decrease from the $25.3 million generated in the same period last year. In their investing activities, they spent about $12.3 million in the first half of 2026. A big chunk of that, $13.1 million, went into adding to their real estate investments. This includes costs for building the new Miller Medical Plaza. They also received some cash from selling that parcel of land in Chicago. On the financing side, they borrowed a net $9.4 million on their line of credit, but this was more than offset by the dividends they paid out, which were nearly $20.8 million. So even though they are bringing in cash from operations, they are paying out significantly more in dividends, which is why they need to tap into their line of credit. Now, a really important part of UHT's story is their close relationship with Universal Health Services, or UHS UHS is not only their largest tenant, accounting for about 40% of their revenue, but a subsidiary of UHS also acts as their advisor. Their leases with UHS facilities are long-term with options to renew. For example, the lease on McAllen Medical Center includes a bonus rent component based on the hospital's performance, which is interesting. They also have significant leases with Aiken Regional Medical Center and Canyon Creek Behavioral Health, which are accounted for as financing arrangements because of UHS purchase options. The annual rent for these alone is over $6 million. Altogether, these UHS hospital leases make up about 25% of their total revenue, and when you add in other UHS related tenants, it's around 40%. This heavy reliance on a single related party is a significant factor to watch. Speaking of risks, they've got a whole section dedicated to them. One of the top risks they highlight is that substantial portion of their revenue, depending on UHS, they can't guarantee that UHS will renew its leases. And if UHS decides to buy the properties instead of renewing, their future revenue could take a hit. Another big concern is the impact of rising interest rates. They've seen their interest expense go up, which hurts their net income and their ability to borrow money on good terms. This is a common theme for many REITs right now. They also mentioned some new legislation, the One Big Beautiful Bill Act, that could limit Medicaid enrollment and spending. This could negatively affect the revenue of their tenants, including UHS, and therefore impact UHT. On the market risk side, they are using interest rate swaps to manage their exposure to changing interest rates. They have about $165 million in notional amount across 3 swap agreements. They estimate that a 1% change in interest rates could impact their net income by about $2 million. This highlights how sensitive their earnings are to interest rate movements. So what is the story here? UHT is showing solid profit growth, partly due to a one-time land sale. They are investing in new properties and have increased their borrowing capacity. But they are also paying out a massive amount in dividends, which strains their cash flow and forces them to borrow more. Their heavy reliance on UHS and the broader risks from interest rates and healthcare legislation are the key things to keep an eye on. Now, looking at these results more broadly, UHT appears to be in a transitional phase, navigating rising interest rates and maintaining a strong relationship with its primary tenant. The large dividend payouts are attractive to income investors, but the reliance on borrowed funds and a single major tenant presents a notable risk. What I am actually looking for is how they will manage their debt levels as interest rates potentially remain elevated, and if their tenants can continue to absorb rising costs without impacting rental payments. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives.